This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
I'm Alix Steele. Paul Sweeney is off this week. So over the next hour, I'm going to dig inside the big business stories impacting Wall Street and the global markets. Because each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we're going to take a look at some of the discount grocers' rising popularity and how Spotify is dialing up on the volume on margins. But first, Bloomberg News reported that potentially life science company Danaher is looking to buy out CDMO giant Catalent. Now, that would create a bioprocessing juggernaut with about $11 billion in revenue. So let's get more on what this would look like, how it would affect the space if it were to happen. We're joined now by Bloomberg Intelligence healthcare analyst Jonathan Palmer. What is Danaher and what would Catalent bring to it? Just describe to me the two companies.
Sure. So Danaher is a life science technology company that nobody in the public has heard of, but investors know very, very well because it's such a great compounding business. And so it was actually started in the 80s as a real estate company and then slowly moved into industrials. And then over the last decade has moved out of industrials squarely into healthcare and into science-focused companies. And they do this all through acquisition. I don't know the number off the top of my head, but I think over the last 30 years, they've done hundreds of acquisitions. I wish your co-host Paul was here with us because there's actually a little bit of a technology angle and media angle here. The brothers who ran the company and founded it, the Rails brothers, are very active in producing movies like Wes Anderson's movies. So they're still on the board. They're still somewhat involved, but it's been a massive wealth creator over the last 30 years. It
is funny because I know Danaher as an industrial. Like when I hear the word Danaher, I'm like, oh, that's an industrial company. But literally, what do they do now? Like, is it just like device stuff?
So they sold off their Stanley tools, all their test and measurement, which was for the electronic industry. And about a decade ago, they started buying life science technology and diagnostics companies. And they planted their flag with a company called Beckman Coulter, which was a diagnostics firm, and have slowly been adding to that healthcare portfolio. So they do diagnostics. They do what they call pure life science technology, which is kind of the R&D instruments that go into research labs. And now they're doing what they call bioprocessing or bioproduction vis-a-vis their biotechnology group, which was founded through two acquisitions as well. One was a company called Paul, which they acquired, I believe, in 2015. And then what was called GE Biopharma, which they bought from GE about 2 years ago, which they now call Cytiva. So these companies make all the equipment for biotech drugs. And biotech drugs are grown in cells. They're not synthesized via chemical reactions. And so there's a whole cottage industry around the production of biologics, and there's only a couple players. It's Danaher, it's their competitor Thermo Fisher, and then two companies out of Europe, Sartorius and Merck Millipore. And so they really have a really strong position in this market.
So what would Catalent give them?
So Catalent's interesting because they're a CDMO, as you said, which is a contract drug manufacturer. So they manufacture drugs on contract for smaller biotechs and even big drug companies. So the best example over the last couple of years is Moderna, which was a small company which had never produced a drug up until the vaccine. When the vaccine needed to be produced, they didn't have the infrastructure, so they turned to Catalent to help them produce their vaccine doses. And so Catalent has an expertise in biologics and small molecules and consumer products. But it would really scale that bioproduction business from not only selling the equipment for it, but also being a service provider as well. So they could offer customers everything from their initial scale up and initial production to when they get to scale, maybe selling them the equipment as well.
So there would be synergies.
There would definitely be synergies.
What price would this kind of deal get done in?
That's the interesting question because Catalent flew high on the pandemic, like all pandemic-driven stocks, and has since fallen by about 50%. So, I suspect maybe a premium of maybe 100% from where it was trading prior to the deal announcement, which would probably put it around 18-ish times EV to EBITDA, which in this life science technology space is not a wild premium. It's a pretty kind of standard, takeout premium for companies with growth and good margins. I mean, Danaher is also interesting in that they have their Danaher business system, which has its roots in Japanese, Kaizen management techniques where they're always trying to strip out costs. So they come in, they take a company that has a 20% operating margin. 2 or 3 years later, it's a 25% operating margin. A couple years after that, it's 30% margin. I'm pretty sure they could do the same thing with Catalent.
All right, Jonathan, thank you so much. Super appreciate it. Jonathan Palmer, he's Bloomberg Intelligence healthcare analyst. Let's turn now to the housing sector, where green shoots are emerging in the U.S. market. For more on what this means, we're joined by Bloomberg Intelligence senior industry analyst Drew Redding. Drew, has the housing market bottomed?
So let me first start with an important disclaimer, and that's that activity in the new home market in 2023 is still well below the really frenzied pace of the last couple of years. We're still 25 to 50% below last year on volume, depending on the market. So I think that's important context, but from an investment perspective, of course, we're looking for clues out there that things may be getting less bad or maybe the market has bottomed. And, to that end, as you mentioned, there have been some positive signs over the last couple of weeks. Most importantly was the pullback in mortgage rates. We did at one point hit a 5 handle on the 30-year, and that's down from as high as 7% back in November. So that was pretty significant progress, and builders have noted a positive response from buyers as that has happened.
To that point, I'm just wondering what the actual supply situation looks like. I appreciate the new home market and the sales are still well below what we've seen in the last couple years. But I keep hearing that supply, in essence, for the new home market is still the problem, and that that's going to create a floor for housing prices kind of no matter what mortgage rates actually do.
It's a good point. So there is a lot of supply that will be coming to the market over the next 6 months. If you look at the number of homes that are under construction, they're obviously elevated over the last couple of years. That's because builders have had such a problem completing them due to the supply chain challenges. So over the next couple of months, there is going to be a lot of inventory coming to market. But on the positive side, what we're seeing is that builders are increasingly willing to play ball with the consumers. And what I mean by that is builders are willing to sacrifice margin. They'll lower the base price. They'll offer incentives. They'll help with down payments. They'll buy down your rate. So if you're a willing buyer and you're out there in the new home market, one, there's going to be the inventory for you to purchase, and two, the builders are going to make a deal with you. So
what does that mean for the builders? Does that hurt or help them? Can they make up in margin? Can they make up in volume what they're losing in margin?
So the short answer is no. I mean, margins are going to fall pretty sharply this year. We're looking at 400 to 500 basis points across the board. Volumes are still going to be down. So earnings we have down somewhere in the range of 30 to 40% next year. But from an investment perspective, of course, this has kind of been well communicated. People know that earnings are going to fall this year. The important thing to point out, though, is that even though earnings are going to fall, builder book values are still going to rise. And when you have a group that's valued based off price to book, that actually puts some stability into valuations.
Okay. So maybe there's some help there. Are they getting any help on the supply chain problems? What's sticky, what's not?
So we have seen a little bit of progress. You have to remember cycle times in the new home market have lengthened significantly, not just because of product constraints, which were probably most notable, but also on the labor side. So builders are starting to see some relief kind of with those front end trades on the framing side. And that's because there's not as many new starts going into the ground. Where they're seeing problems on the labor side or on the back end as builders are completing that finishing work to get the homes delivered. In terms of materials, there's not as many bottlenecks as there was previously. We're seeing material prices start to come down as well, so that should also help in the back half of next year.
Which home builder is best positioned right now?
So we think in this market, a couple things matter. Of course, where you're building, just because of the bifurcation of markets, but also what kind of business model you're running. What we're seeing is that builders who operate more of a spec-heavy model, meaning they're line building homes before they have a buyer, they have inventory on the ground, we think they're going to be more successful. And that's because buyers right now are looking for certainty. They want to know what their mortgage rate's going to be. If they buy a spec home, they could close in 60 to 90 days. They could lock in their payment, and they don't have as much interest rate risk.
who's in the most trouble? Like, I'm assuming if you're most exposed to the high end, for example, can I infer that?
So when you talk about buyer mix, there's at this point, we don't really think there's anywhere to hide. Each segment kind of has their own challenges. The low end is obviously the price-sensitive buyer. The middle of the market is confronted with the mortgage rate lock-in effect. They're disincentivized to trade up to a higher mortgage rate. And then at the high end, you have volatility and the negative wealth effect because of what's happening in markets. So there's not really one area to hide out. It's kind of been across the board pain for the builders. But bigger picture, we do think that those who focus on affordability are going to be in the best position. So we like the lower end of the market.
I'm trying to sell a condo, man. I don't know if you're making me feel better or worse. It feels complicated. Drew, thanks a lot. Really appreciate it. Drew Redding, Bloomberg Intelligence Senior Industry Analyst. Coming up on the program, we're talking media as Spotify works to fine-tune its narrative. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele, and this is Bloomberg.
This is Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Let's turn now to Spotify. So it was really into podcasting, and there was a lot of heavy investments. Now, that part of the thesis is moderating, and that really removes an overhang for gross margins, which really been at limbo at around 25%. You also have solid user momentum. So what does that wind up meaning then for the stock? For more on this, we're joined by Bloomberg Intelligence Senior Media Analyst Geetha Ranganathan. Geetha, it seems like the investment into the podcasting world can take a little bit of a back seat. So what's the upside then for margins?
Yeah, so this is a theme, Alex, that is playing across all of media right now, which is basically aligning costs and growth, and that is really setting the long-term narrative. So for Spotify, they've always had fantastic user momentum. As you just mentioned, the problem has really been on the margin side. So for a business that is going to generate something like about $15 billion in revenue, they still don't have profit. And a large part of that is because, they really don't have a lot of leverage because they don't own their content. This is the music content is something that they license from the labels. So there's not a whole lot of leverage that they have there, but they have been investing in the podcasting business, significant investments there. But those are going to moderate right now, which is why we're seeing a little bit of an inflection point when it comes to the gross margins. And, when you have that combination of user growth and a progress on the margin front, we do see meaningful profits, and we do expect them to turn profitable sometime in fiscal 2024.
Yeah, so you're looking at, well, this is a consensus, actually. Gross margins around 26% in 2023, 27% in 2024, and that's after being stuck around that 25% range. Do you agree with those consensus forecasts?
I do agree with those, and I think there is a potential for that to even expand further, just as they kind of go on a lot of different initiatives, on a lot of different growth initiatives, whether it is with podcasting, whether it's with audiobooks. So they're trying to really dive into new verticals, not just look at this as a music streaming platform, but really kind of push forward on a lot of non-music initiatives, which then kind of helps them in their advertising business, because when you have all of these new verticals, there's obviously a lot more ad inventory that you can sell against, and that helps them. Those are revenue numbers that kind of fall straight to their bottom line, so that really helps them with their margin expansion story.
I have a dumb question. If you're looking at the podcasting universe for Spotify and they stop the massive spend, does that mean that their content ability goes down, or was this the spend on the infrastructure and stuff that was going to make podcasting a big moneymaker for them?
No, that's exactly what it was. It was kind of setting all the infrastructure,
it was like setting the stage for them.
Exactly. Just kind of building all of the technology so that they are able to then ramp up both the number of podcasts as well as the number of ad spots that they can sell for those podcasts.
So based on that, where else might they need to see some big spend before they get to capitalize? Are they kind of done all across the board?
They are done, I think, for the most part. At this point, it's really kind of refining the story a lot. But remember, yes, they have made all of these considerable investments in podcasting. But podcasting is really what it comes down to is it's an advertising business. That is really where they're kind of looking to grow. But we are in an ad market that is somewhat soft right now. So I don't think we're necessarily going to see a huge ramp up on the podcast front, at least in terms of revenue growth. That said, at least since costs are moderating, that helps the margin story. I think one of the other things that we're looking at for Spotify is potentially whether they will raise prices, because some of their competitors, both Amazon and Apple Music, just recently raised prices. So that kind of, I think, has the street cheering for a price raise in the coming months.
If a consumer has a slowdown, though, is this recession-proof?
I think what we've seen, at least in the music streaming business so far, is that it's been fairly resilient. So much more resilient than the video streaming industry, for instance. People don't necessarily, churn out of these services. So I think, they will stick, even if there is a little bit of a price increase. And Spotify has been really, really very deliberate about this. They haven't, so at least in the U.S., they haven't raised prices since launch. It's been at the $9.99 for the individual plans. So I think that does give them pricing power, especially with them adding so much more content and so many new verticals.
What kind of overall market cap will a podcasting universe have? Like, how big can this market be?
So right now, if you kind of look at the market in the U.S., I mean, this is about a $2 billion market or so, but it can potentially get to about 10 or 20 billion. At least that's what Spotify is hoping for. That's what some of the industry forecasters are projecting as this kind of becomes more mainstream, and as there's convergence of all these different audio formats, they do expect podcasting to take off in a much, much bigger way. That said, again, we're kind of in this very slow market right now when it comes to advertising, and really all of the revenue that is being generated on the podcasting front is through advertising. So it might take a little longer than what people had initially projected.
Who are the competitors to Spotify?
There are lots of different competitors. So we obviously have Apple is the next biggest competitor. They have about a 16% share. You have Amazon, which has a 13% share of the market. Spotify, by the way, is a leader with about a 35% share almost of the global streaming market. You have YouTube, which has about a 10% share. And then, of course, you have, some of the Chinese players. So Tencent Music is one. You have Deezer. So it's a pretty competitive marketplace, but Spotify is definitely the leader by a large margin.
Does that the pie chart that I'm looking at, does that actually grow, or is it going to be about taking market share then from like Apple or Tencent or Amazon?
That pie will actually grow. So if you kind of look at the number of people who are willing to pay for a music subscription, that's about 1.1 to 1.2 billion people. The total number of current global streaming subscriptions is about 600 million, and Spotify has 200. So that's that 33% share. So yes, there is considerable upside for them, just in terms of the total addressable market, and then, of course, them taking share also from other players.
Does the stock reflect the margin improvement yet?
I think it does. We've obviously seen, after the reported results, we've obviously seen quite a bit of a run-up. And I think that's just basically investors kind of heaving a sigh of relief. There's some more visibility definitely on the margin front. I think as we get into, 1Q and when they show us a little bit more progress. So it's not just the gross margins. We're also going to see some improvement on the operating margin front. They did lay off of about 6% of their workforce. So that should flow through to operating margins. So overall, I think the margin story is definitely getting way, way better, which is why I think now finally the street has some visibility on just this whole business itself kind of turning profitable, hopefully within the next year or so.
But I don't know, if they have such good margins and good growth rate, like, do they compound it by growing, or does Apple find them interesting? I don't know. But I was wondering, like, the streamers on Disney, HBO Max, like, do they need to start diversifying the kind of streams that they have? Hulu, because there's only so much video streaming that goes around, right? Like Netflix getting into gaming, like, is podcast the natural next step? I don't know. There's not a whole lot of complementariness,
if I can use that word. Yeah, there's not a whole lot of synergies, I think, between the video and the audio streaming business necessarily. So I don't necessarily see any of those players getting into podcasting or getting into audio in a big way. It's just because all of them kind of want to control their content. And with the streaming music business, just by definition, the labels control the content. So, about 75 to 76% of whatever Spotify generates through revenue kind of goes back to these labels, whether it's a Warner Music, whether it's a Universal or a Sony. So there's very little control. And what all of these other media companies have been trying to do, especially the video owners, is kind of create more and more of their own content and not be so dependent on licensed content. So that kind of defeats the purpose in a way. So I'm not necessarily sure that they would be interested in audio, at least right now.
Yeah. That's Geetha being nice, saying, yeah, no, that's not going to happen. All right, Geetha, thanks a lot. Geetha Ranganathan, Bloomberg Intelligence Senior Media Analyst. Coming up on the program, can discount grocers' outsized gains actually erode the traditional store lead? We're going to find out. You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
We will be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide. We have a little battle gearing up between the popularity of the discount grocery retailers like Aldi and Lidl versus the big giants like a Walmart and Kroger. Can the two coexist? Can the little guys really compete? To help us answer the question, we're joined now by Bloomberg Intelligence Senior Packaged Food and Retail Analyst Jen Bartashis. Jen, before we get into the competition, I feel like it's worth talking about how Lidl and Aldi have grown and sort of what their command of the market is right now.
Yeah, it's been really impressive. I mean, Aldi has been in the United States since the 1970s, so they've been around a really long time. Lidl has been a much later entrant and has only been in the U.S. for the past few years. But both of them are increasing their store count really quickly. In fact, Aldi was the fastest growing grocery chain in the United States last year. And they have, way over 1,000 stores. And so people take for granted just how quickly these chains are growing and that they can be placed in very small stores. And so they're in neighborhoods. And so they're very accessible to a lot of people as well.
How do they do it? Do they have generics? Do they just really eat it on margin and hope that volume makes up for it? Because I could imagine that a Kroger and Walmart are able to buy in bulk and really be aggressive on pricing.
They are, but these stores actually are more competitive on price than a Walmart or a Kroger. But the majority of the products they sell are private label products, but it's not what most people might remember private label to be. So if you go in an Aldi, you can buy gluten-free products. You can buy organic products. It's very, very consistent with what you would find in a normal grocery store. But because these stores are small and they offer only a limited assortment, so they might have only 3 different types of pasta instead of 20 types of pasta, they sell really high volumes on the limited number of things that they sell. So for them, they make actually good margin because they're selling at huge volumes on those products. So it makes them very competitive, and it allows them to keep their prices oftentimes lower than at grocery stores.
Is this the real deal for them? I mean, you mentioned that Aldi has been around for decades. Is it happen to be a post-pandemic inflation story for them, or is this a sustainable market share steal, really?
This is a sustainable market share. The discounters have been slowly leaching share away from traditional grocers for quite a long time, even starting before the pandemic. Obviously, they're getting a big boost because of inflation, and the more expensive food is, the more people look for places to buy food that is less expensive. But the total market share that these discounters are garnering has been growing consistently for at least the last 10 years. And I think, a lot of people get wrapped up in the idea of like Amazon, or some of these big companies going into the grocery business, but they don't really think about these smaller stores that are equally taking away market share.
Yeah, absolutely. How does the traffic growth there compare to the big guys like a Walmart and a Kroger? And is there anyone in the middle between like an Aldi and a Kroger, for example, just picking them out of thin air?
Yeah, so the traffic patterns into these stores have been really strong in the past year, and we're seeing traffic growth into discount stores versus a much slower growth at the traditional supermarkets and at the discount stores like Walmart and to a certain degree Target. In terms of in the middle, there's not really another player that's in the middle, unless you count someone like a Trader Joe's. They sort of bridge it because a Trader Joe's, it's a little bit more premium on price, but it's still very much private label, and the stores are still much smaller than your typical grocery store. So it would be something similar to Trader Joe's that might be the only thing that's kind of in between an Aldi and a Kroger.
The last time I went to Trader Joe's was like a 6 p.m. on a Sunday, and I am forever traumatized. You have a great map in your deck that takes a look at the stores of, say, Save-A-Lot, Trader Joe's, Lidl, and Aldi, and it feels like it's really the Northeast, the Southeast, and it's kind of spreading. Do these discount stores, are they moving? Are the discount grocers really going to expand out west where they don't really have that much of a presence?
Yeah. So interestingly, Aldi and Trader Joe's are owned by the same company. And so when you combine those two together, it's a little bit more of a national footprint. But Aldi has a very heavy presence through the Midwest and into the Northeast and into the Southeast. But a lot of their growth has been happening by moving west. And so we expect that to continue because everywhere they open a store, they're getting pretty good, solid traffic into those stores because they are competitive. Right now, it seems to still be even early innings for these discount stores, and they can't be ignored as a serious competitor to the companies that we traditionally follow.
Did the stocks reflect this yet?
I think that people are kind of aware of it, but because neither Aldi nor Lidl are publicly traded, they're not so much in the consciousness. And so I think that there certainly is a risk to these larger companies, but it is a long-term risk, and making sure that they stay competitive and that they're able to, offer the loyalty perks that they need to do to keep their customers close at hand.
Which then also brings me to the last point, which is online shopping. Do the smaller guys, do these discount grocers have an online shopping setup? And is that how people are truly going to be buying their groceries? Like you mentioned, Amazon, et cetera, or does it really just have to be going to the store?
Well, what we find, regardless of who the retailer is, a customer who is engaged at both the store and online spends significantly more with that retailer than they do with a retailer where they only visit the store or only shop online. And so up until the pandemic, the discount grocers, the Aldis and the Lidls, had almost zero online presence. Then they forged relationships with companies like Instacart to offer, some kind of solution for people. But Aldi just recently announced that they're going to actually have their own online platform. And so they're moving into that space that was a competitive advantage for the grocers and, the Walmarts of the world. And so as they continue to build that out, they're seeking that same type of loyalty and that same type of increase in spending from somebody who is engaging at both visiting the store and visiting online.
Really amazing insight. Love it. Jen Bartashis, thank you so very much. Bloomberg Intelligence Senior Packaged Food and Retails Analyst Jen Bartashis. Let's turn now to European banks. Let's just exclude Credit Suisse for the time being. They have some idiosyncratic things they're working out. The rest of the European banks are looking at some revenue that's going to be facing an inflation test in the coming year, particularly as we're looking at the ECB that's going to continue to hike rates. For more, we want to welcome Bloomberg Intelligence Senior Banks Analyst Philip Richards. Philip, how did these big banks do in the fourth quarter, and what is the consensus outlook here for this year?
Yeah, actually, the banks at the moment are doing surprisingly well. In terms of, first of all, mainly on the revenue side. I mean, obviously, the banks have been through a very difficult 5-6 years in terms of negative rates across Europe, which is a real squeeze on bank margins, and therefore their revenues have been really hurt by it. So their whole deposit balances, basically, the banks have been losing money. So coming about the middle of last year, when rates started rising very sharply, suddenly we had these huge interest rates, and suddenly these banks are making massive amounts of money that they weren't making previously. So in terms of, if you look at the numbers, so the banks, they're soaring, and we're talking about revenue growth of upgrades about between 10 and 15% for a number of these banks, and they're beating estimates, analysts, by similar sort of numbers.
What about provisions, though? At the same time comes setting aside more money for losses. Where are they with that?
Yeah, well, actually, again, so I'm going to sound positive here, but there is a caveat coming at the end. But it's actually very good because when we had the whole COVID and the crisis there, and the big slowdown that we had, the banks took huge amounts of provisions because they thought we're going into a big recession. But actually, in reality, lots of the European and the global governments stepped in and bailed out a number of companies to stop there being a big recession. So the impact is that these banks had loads of build-up of provisions. So actually, when you look at the earnings today, and we saw that in the four-quarter results so far, actually the new charges the banks have been making have been actually very low, and that's because they're able to release some of these provisions they made previously.
Which bank is set up the best for a mild downturn scenario, for example?
Yeah, well, I guess it's going to be the case of the banks which is best positioned for what we're saying there. So the first of all, is in terms of the revenue boost they've had, in terms of that big on the top line, but that's going to start running out now because rates are going to not be increasing much further. So which banks can keep that revenue growth going and at the same time are not going to have that big increase in provisions. So it basically depends on where the economic crisis hits. So if, for example, 2 months ago, we were thinking Germany was going into by far the biggest recession across Europe, And therefore, you would expect then, it'd be Deutsche or Commerzbank would get the increase in bad debts. But that certainly swifted quite a lot over the last 2 or 3 months. And now looking at actually most of Europe will avoid a recession. And actually maybe some of the UK banks might be some of the worst impacted if we do go into an economic downturn. Mm-hmm. So it really does depend on what happens on the economy, because that's, as that downturns, that's going to hit the impairments.
We've talked about the rally that a lot of these banks have already seen. As the rotation out of the U.S. and into value took hold, no real sector except for energy benefited the most, aside from these European banks. How do we know that they're not a value trap this time again?
No, I think it's a very fair question, and I'm certainly not saying they're not a value trap, because I think it's almost been a case of banks have been almost like this sort of sector, particularly European banks, not in the US, and where the conditions are much stronger, but almost no one wants to touch these banks because they're struggling, they're barely making money, their capital ratios are very low, and any time they do sort of look like they make money, you get these new bank taxes when the government sort of come in and say, we'll have that, please, and take it off them. So people have been wary on them. But say now the conditions are so much better, and yes, there might be more government sort of tax grabbing going on. But the fact is that these banks are going from earning 4 or 5% return on equity, suddenly they're now doing a 9 or 10. They're actually starting to operate more like proper, profitable companies again. Yes, I'd say, bottom line is, I don't necessarily think there's a massive value to go. So we've had that big 30% bounce, which I think is justified by the fact you've had these big rate rises. But how much further interest rate is going to rise from here? Maybe 25 or 50 basis points. So we're basically coming to the end of that, and at the same time, you're going to start getting those bad debts coming through from recession. Mm-hmm. And actually then the third factor is obviously you've got inflation as well. And we've actually seen that coming through on the cost line. And actually, that's kind of been hidden over so far, because the revenue beats have been so good, these misses on costs have been kind of missed or ignored. But when those revenue upgrades run out, then you can start looking at these costs much more. And so with inflation running at 10%, as it is across a number of European countries, the staff are naturally saying, well, wait a second, we want some sort of 8 to 10% pay rise as well. And so that's going to hit the banks as well.
Yeah, I was going to say, is the cost inflationary or is it the cost to keep talent? But I guess they become one and the same.
Yeah, I mean, it's obviously across different sectors as well. So on the retail, I think you would say it's much more inflation-driven, where it's much more sort of salaries in line with the economy. I think when you go into the actual investment banks and the higher, not higher skill, but the much more difficult areas to get into, I think that's where it's much more talent-driven.
Compare and contrast the European banks on costs, trading revenue, and investment banking versus the U.S. guys.
Well, so the U.S. banks are in a much stronger position, and you can see that. If you look at the profitability they're generating, if you look at the valuation they're trading at, those banks are trading at regularly around 2 or even 2.5 times book, whereas the number of European banks trading at more than 1 times book. You can actually pretty much, there's only really the Nordic banks and 1 or 2 exceptions across Europe. So most banks are trading at a discount still. And the reason for that is, we have got this problem, the revenues are improving, but they're still nowhere near established, I would say, as it is in the US. So in terms of the revenue line is mainly the issue for these banks, which are not generating enough.
I mean, I can understand why U.S. banks might be in a better spot, but it feels like in terms of catch-up potential and what's valued, the European banks have a lot more room that they could make up if things actually macro-wise turn out okay.
I think that's exactly right, and I think you need the regulator to kind of be on their side. I think, say a number of because of the fiscal squeeze was having across Europe in a number of countries. When you're a politician, it's very easy to say, "Well, we'll go and get the money from the banks." No one likes to pay extra taxes, but everyone wants to be in a better financial position. So if you're attacking the banking sector, it's kind of seen as quite popular over here. Whereas I think people, I think in the US, see it more as you've got to treat companies fairly.
Yeah.
So you do have that conflict as well. But I completely agree. The banks are trading a much lower valuation. If conditions do calm, we do go into economic growth, and we also see these 8, 10, 12% ROEs and becoming more established, then I think the longer-term picture has to be high returns.
Mm-hmm. Yeah, it's like they're not priced for perfection, but you got to get all the circumstances to line up. Really interesting, Philip. Thanks a lot, Philip Richards, Bloomberg Intelligence Senior Banks Analyst. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele, and stay with us because today's top stories and global business headlines are coming up right now.